And thank you very much. A lot of people talk about the self-fulfilling prophecy or even the general America in decline. You say no. What are we missing, those who say that? And I'm not saying I'm one of them, but people who say that, what are they missing?
So we've had a long-standing theme within the investment strategy group of U.S. preeminence, and it's a justification essentially that we've had for our clients for the past decade to basically have an overweight to U.S. assets in their portfolios. The bedrock of that view has been the idea that the structural integrity of American institutions, the corporate governance, the rule of law, all of these factors that are things that play into the dominance of American companies, for example, around the world, are things that basically support having an overweight position.
For instance, when people sign contracts with firms outside the borders of the United States, sometimes, most times, there's a provision within that contract that if there's a legal issue, it gets resolved in the Southern District of New York. Is that the kind of thing you're alluding to?
Right. And just basically, if you think about, the U.S. versus an emerging economy, for example, the rule of law in this country where you can actually have legal recourse for somebody who doesn't honor a contract and things like that are very different than the type of legal treatment you would get in other countries. But I think the main point I would make, though, is that many of the people are anchoring on these things being unprecedented. The president challenging the Federal Reserve, for example. This idea of immigration limits. And when we look back historically, one of the things that we think is very important in our investment philosophy is history is a useful guide. And we look back and we see, for example, that President Johnson actually asked about whether he could remove, Fed chairman. That Ronald Reagan, for example, had instituted, quotas on Japanese auto imports, and as well as, had instituted tariffs on motorcycles from Japan. So these types of things are not new. American institutions have withstood these challenges in the past, and we think that they will again this time around.
Big picture, institutions are bigger than any one person or individual.
Right.
Now, I want to get your take on a recession. There have been talks that one's on the horizon. You all don't see the probability of one. Walk us through. What do you see there? Why isn't one coming in the near term?
So we have about a 15 to 20% probability that we've placed on recession. That is up from the 10% or so that we thought last year. So it's definitely increased, but it's still low. It's definitely not a base case. It's more a risk case scenario. The reason we even care about recession risk so much is about 3/4 of bear markets and equities historically have been born during economic contractions. And so it's the single greatest risk to an investor's portfolio. When we look at what typically causes recessions, there's 3 factors. So one is the Fed tightening too aggressively in response to high inflation. When we look at that risk today, we see that the Fed has been tightening at a pace that's about half the historical average, so relatively slow. And importantly, they have now indicated that they're likely to pause that tightening campaign. We also know that inflation is not that pernicious. And so when we look at that particular risk, we don't think that's going to tip the economy over. Secondly, you have imbalances in the economy, which has typically led to recession. You think about the technology boom in the late 1990s or the housing bust. When we look at excesses today in the economy, we just don't see those. And I think that's one of the benefits of the very slow recovery that we've had. It's been 2% GDP for a decade. That hasn't built up the type of cyclical excesses. The final trigger for recession has been oil shocks, typically, or exogenous shocks. And when we look at the oil backdrop today, we're oversupplied. And OPEC has actually cut production to try to actually take oil supply out of the market. And so we look across that litany of factors. We just don't see any of the typical triggers of recession being that worrisome today, hence our low probability.
Well, I want to get your take on your clients because you've given them essentially the same theme for the last 10 years, which is the American preeminence, overweight U.S. equities. What do you hear from your clients when you're having those conversations with them? Because you all do cater to that higher net worth individual. What are they concerned about?
Well, they're concerned about the 2 things we just talked about, not surprisingly, recession risk and, is the U.S. in decline? Is this administration or is this set of challenges we've talked about, is this unprecedented? Is this reason for me to be getting out of the equity market? So those are the types of things that are definitely top of mind with our clients. I think as a general rule, they are very cognizant of the fact that this is a 10-year expansion, a 10-year bull market, and I think people have been very scarred, and rightly so, by the last 2 equity declines, which have been 50% plus versus typical recession equity declines, which are more like 30%. So I think people have that recency bias. They've seen these large declines, and that has therefore made them very sensitive to the end of the cycle. And so they're very focused on things that could end the cycle.
Brett Nelson, appreciate your being here. And remember,
Thank you for
Brett
having
Nelson
me.
is head of tactical asset allocation at Goldman Sachs. A lot of people listen to what you have to say, and I think it's good to hear a little bit of optimism and avoid self-fulfilling prophecies. We're going to be right back after this.